Welcome to the deep dive. Today, we're doing a deep dive straight into some incredibly valuable source material, the December 2024 TX UK Examiners Report.
Yes, absolutely.
This isn't just a dry summary. Think of it as getting direct feedback from the people who actually marked the exam papers.
It really is invaluable,
Yeah.
This report gives you a direct look at where candidates did well, and crucially, the specific areas and, common mistakes that cost people marks. It's the examiner's perspective on what truly matters.
And our mission in this deep dive is basically to unpack all of that for you. We're going to pull out the absolute key takeaways, shine a light on those frequent errors, and give you a much clearer picture of what the examiner is actually looking for in your answers. Okay, let's unpack this.
Right. And one of the strongest pieces of advice, straight from the source really, is using this report alongside the published sample exam, the one on the ACCA practice platform. They graded the papers, they know the pitfalls.
They certainly do. And right up front, they emphasize that this is a computer-based exam, a CBE. And a really important point about CBEs is that candidates don't all get the exact same set of questions.
Which immediately leads to, a crucial piece of study advice. You absolutely must revise all areas of the syllabus. The report explicitly states that question spotting, trying to guess what will come up, it's just not a viable strategy. You don't know which topics you'll get.
That's a vital reminder. Now, something fundamental that, according to the report, continues to be a challenge for some is showing your workings. Why is that still such a big deal?
Oh, it's critical. Because marks are awarded for your method. Even if you make a simple arithmetical error along the way, if you just put a final answer and it's wrong, you could get 0. But show the correct steps. You could pick up significant method marks. It's about demonstrating you understand the process.
That makes total sense. And for those using the spreadsheets in the CBE, the examiner offered a specific practical tip. Avoid putting detailed workings within a single cell.
Yes, exactly. Trying to cram complex formulas into one cell it dramatically increases the likelihood of syntax errors. Mistakes that break your calculation and cost you marks. Spread it out, make it clear.
Right. Beyond the technical mechanics, the report also hammered home that a significant number of common mistakes simply come from not reading the question carefully enough. Things like misinterpreting dates or incorrectly identifying disallowable expenses in a scenario.
Attention to detail is paramount, honestly. Those small words or numbers can change the entire calculation or the tax treatment of an item.
Yeah, I can see that. And finally, in terms of general approach, they advise candidates to answer questions in the order the information is provided in the scenario.
It just helps you maintain a logical flow as you work through the data,
Yeah.
Reduces the chance of missing something or misapplying information.
So that's the foundational guidance from the examiner. Revise everything, show your workings, be careful with the tech, read precisely, and follow the scenario's order. Let's shift gears now and dive into some specific concept examples highlighted from Section A, the objective test questions.
Good idea. These examples really illustrate where candidates struggled with specific technical rules, even in that shorter format.
Okay, first up. Payments on account. The report gave an example. I think it was a total income tax liability of £40,000, which included £6,000 of PAYE.
That's the one.
And the key rule the examiner saw tripped candidates up here is that payments on account are based on the prior year's self-assessment liability.
Yes.
Not the total liability that includes PAYE.
Exactly. So in that specific example, you needed to take the £40,000 total liability and subtract the £6,000 of PAYE that was already deducted at source. That leaves £34,000 as the self-assessment liability. The payments on account are then half of that figure, so 2 payments of £17,000 each. Missing that distinction between total and self-assessment liability meant the whole calculation started off wrong for some.
Okay, I see how easy it would be to just grab the 40K. That distinction is crucial then. Next example, company residence. The report revisited the fundamental rules here.
Right, so a company is considered UK resident for tax purposes if it meets either of 2 tests. It was incorporated in the UK.
Okay.
Or its central management and control is exercised in the UK.
So based on the examples they gave, a company like Zebek Inc., it could be resident here even if incorporated elsewhere if its key decisions are made in the UK.
Right.
And Y'all Ltd would be UK resident just by being incorporated in the UK, even if its day-to-day stuff is managed somewhere else.
Exactly. Understanding these 2 separate tests is just fundamental to determining which country has the primary right to tax a company's profits.
Makes sense. Moving on to capital gains tax, specifically focusing on exempt gifts. The report defines a wasting chattel as an asset with a predictable life of 50 years or less.
And they use the example of a motorboat. Because it's considered a wasting chattel, its disposal is generally exempt from CGT.
Okay, but here's where it gets really interesting and specific, according to the report. They contrasted that with non-wasting chattels, things like antique jewelry.
Right.
For those, the exemption only applies if both the sales proceeds and the cost were less than £6,000. That 6K threshold is very specific and applies differently.
It really does. And it raises an important question. The examiner sees candidates struggle with correctly identifying the type of asset first, because the rules for exemption, particularly that 6K threshold, depend entirely on whether it's a wasting or non-wasting chattel. Get that wrong, and the rest follows.
Right, okay. Last point from the Section A examples. Inheritance tax on the death estate. What did the examiner highlight here?
A few key valuation points, really. For property with a repayment mortgage, you include the net value in the estate that's the property's value minus the outstanding mortgage amount.
Okay.
And confirming that NS&I savings certificates are included as part of the deceased estate for IHT.
And there was a specific type of debt that isn't deductible.
Yes, debts that were not incurred for valuable consideration. You can't deduct those from the estate value. These details are all essential inputs for correctly calculating the taxable value of the estate.
All right, let's move into Section B, the objective test case questions. The report specifically focused on the Christelle case study, which heavily involved VAT.
Ah, yes, Christelle. This tested the application of VAT rules to a specific trading scenario.
So for output VAT on sales, the report clarifies which items were standard rated at 20%. That was only the ladies' clothing sales, right? And importantly, net of any discounts given.
Correct. And children's clothing, as is often the case, was 0 rated.
Okay.
So identifying the correct VAT treatment for different categories of goods is fundamental to getting the output VAT calculation right.
Then looking at input VAT reclaim, the report noted that input VAT was correctly reclaimable on things like marketing services.
Yes, but what tripped some people up was the input VAT on a car used for private purposes. That input VAT is not reclaimable.
Ah, yes, the car. That's a classic trap, isn't it? That dual purpose rule needs close attention.
It absolutely does. It's a frequent source of error, the examiner noted.
The report also mentioned goods taken for own use. What's the rule the examiner saw causing issues here?
Well, when a business owner takes goods from the business for their personal use, VAT has to be accounted for. But it's calculated based on the replacement value of the goods, not the original cost or the normal sale price. The replacement value.
That's a detail that's easy to overlook first, accounting for VAT at all, and then using the correct valuation basis. And here's a surprising detail the examiner noted about simplified VAT invoices. They do not need to show the total amount of VAT charged separately.
Bit counterintuitive, isn't it? They only need to show the VAT inclusive total and the VAT rate applied, a specific rule just for simplified invoices.
Interesting. Finally, for businesses using the flat rate scheme, the report confirmed the calculation method.
Right. For the flat rate scheme, the VAT payable is calculated by taking the total VAT inclusive outputs, so the gross turnover including VAT, and multiplying that by the relevant flat rate percentage for that business sector. It simplifies the input VAT side of things, but you have to remember to apply the percentage to the gross figure.
Right, okay. Taking a breath now because we're heading into Section C, the constructed response questions. These are the longer multi-part scenarios. The report gave significant feedback on the Jessica scenario, which covered income tax, CGT, and IHT.
Yes, these questions demand that you integrate knowledge from different tax heads within a single answer, which is, well, it's a significant challenge.
Let's start with the capital gains tax part of Jessica. The report noted that for shares gifted to a trust, the deemed proceeds are based on the market value at the time of the gift.
That's right.
You then deduct the annual exempt amount, and for high earners, the higher CGT rate applies.
But a really common error highlighted by the examiner here was using an inheritance tax basis of valuation for the CGT calculation.
Oh, wow. So confusing the rules between the two taxes, even though they applied to the same event, like the same gift.
Exactly. CGT and IHT have different valuation rules and different reliefs and exemptions. You must use the correct rules for the specific tax you're calculating at that moment. It's a critical distinction the examiner saw missed frequently.
That's fascinating how different taxes treat the same transfer so differently. Now, for inheritance tax in that same scenario.
The core concept tested here was the diminution in value of Jessica's estate as a result of the gifts made during her lifetime, both the cash and the shares.
Okay, diminution in value.
You then deduct the full nil rate band available. If the trust paid the lifetime tax, That's typically calculated at 20% on the excess above the nil rate band. And depending on who bore the tax, it often needs to be grossed up.
And the report listed several common mistakes for the IHT part too.
Yes, things like incorrectly excluding ISA cash from the calculation, or trying to deduct the annual exemption that's for CGT, remember, not IHT lifetime gifts in this context, or just errors in grossing up the lifetime tax calculation if it was required. Focusing on that diminution in value concept is really key to building the IHT calculation correctly.
Then there was the income tax reduction aspect for Jessica.
Yes, for savings income, the report clarified that exempt income, like ISA interest, is simply not relevant for calculating the income tax reduction for individuals with high adjusted net income. It just doesn't form part of the income tax computation at all.
And handling the dividend nil rate band.
You just need to ensure its application is consistent throughout your income tax computation if the individual has dividend income. And of course, always using the correct tax rates provided in the tax tables for the different types of income is non-negotiable. That sounds obvious, but...
So what does all of this mean for tackling individual income tax scenarios like this one? It sounds like a lot to juggle.
It means you need a really methodical approach. Work through each source of income, apply the specific rules and reliefs for that income type, correctly identify what's taxable and what isn't, and then apply the personal allowance and tax rates based on the total taxable income. Precision at each step is vital.
Moving to the Sheldon scenario, which focused purely on income tax, particularly employment and property income, what did the examiner's feedback highlight here?
They recommended an effective approach. Build a clear main computation for total income, but have separate detailed workings for the employment income calculation and the property income calculation.
Why is that structure so helpful? Just clarity?
Clarity, yes, but it also organizes your work, makes it easier for the marker to follow your steps, and crucially, it maximizes your ability to pick up method marks even if there's an error in one section. It shows the examiner your thought process.
Right. And what specific details did candidates frequently miss in Sheldon's scenario?
Careful attention to detail was crucial again. Things like the exact period living accommodation was provided for, and correctly identifying which property income expenses were disallowable. The report listed specific items where candidates often went wrong.
Like exempt benefits, perhaps?
Exactly. Correctly identifying that a company gym is an exempt benefit, so it doesn't add to taxable income. But conversely, treating living accommodation running costs as a taxable benefit to add, not a deduction to subtract.
Okay, so knowing what's a benefit versus what might be a potential deduction, that's key.
Absolutely. Also, accurately accounting for any payments Sheldon made towards the living accommodation benefit, those payments reduce the taxable benefit amount. Treating medical insurance correctly as a taxable benefit was another point. It's not exempt. And recognizing that reimbursed business expenditure generally just washes out as non-taxable and non-deductible.
I see. These specific items sound like they were frequent tripping hazards.
They were highlighted because they represent common misclassifications, where candidates either treated a benefit as a deduction or vice versa, which significantly alters the final tax figure. The report also mentioned the impact of Sheldon's high income, leading to no personal allowance and additional rate taxpayer status, which of course affects the tax rates applied.
Finally, let's look at the COP LTD scenario, which was all about corporation tax. What was the recommended approach here?
A logical computation structure, basically. Start by calculating the trading profit or loss, and then extend that computation to include other income, like chargeable gains, and deduct items like qualifying charitable donations to arrive at the taxable total profits.
And any presentation tips offered?
Yeah, the examiner suggested indicating items that require no adjustment with a 00 in your computation. It just shows you've considered them. And using a single column approach for deductions can help maintain clarity.
What about capital allowances in the company context? Anything specific there?
A key point the report noted was the need to account for the accounting period length, both when calculating the annual investment allowance limit and the writing down allowances. If the accounting period is shorter or longer than 12 months, you have to restrict or extend those calculations proportionally. For example, a 312th restriction for a 3-month period.
That's a crucial detail that differs from individuals sometimes, isn't it? And there was a specific car example mentioned.
Yes, this is a bit of a niche rule that apparently surprised some. For a car bought and sold within the same accounting period, if it was the only asset in the special rate pool, there's no balancing adjustment made on disposal. You simply calculate the writing down allowance as normal for the period the company owned it.
That is specific. No balancing adjustment if it's the only asset in the pool. Good detail to remember.
Precisely. Now on to chargeable gains for companies. How are incidental costs treated? The report mentioned those.
Yes, the examiner noted they are treated similarly to individuals in that they are deducted from disposal proceeds when calculating the gain. Simple enough.
But crucially, for companies calculating indexation allowance on gains, these incidental costs are not relevant for the indexation calculation itself. Indexation only applies to the original cost and any enhancement expenditure, not the disposal costs.
Okay, another specific calculation detail to watch out for there, and a fundamental difference from individuals regarding chargeable gains generally.
A point the report reiterated, which is a major distinction from individuals and one that still catches people out.
Yeah.
Companies do not get the annual exempt amount for corporation tax purposes.
Right. No 6,000 pounds or 3,000 pounds exemption like individuals get for CGT. That's a key difference that has a big impact on the final number.
It certainly does. And what's fascinating about those indexation allowance rules, even though indexation is being phased out now, is how specific the legislation is about which costs actually qualify for that indexation relief when you're calculating the gain.
The precision needed is remarkable. Wow, that was a truly comprehensive deep dive into the examiner's feedback. We've covered the core guidance on approach and technique, walked through specific concept challenges in the objective tests, payments on account, company resident, CGT on gifts, and IHT on death estates. Then we hit the Christelle VAT case study, and finally unpacked key issues and common errors from the more complex constructed response scenarios involving income tax, CGT, and IHT for individuals, and corporation tax for companies. Phew.
All distilled directly from the examiner's perspective. This deep dive should hopefully give you a shortcut to understanding exactly where candidates are falling down and what areas you need to reinforce in your own preparation.
Yeah.
Knowing the common pitfalls is half the battle to avoiding them, really.
It absolutely is. It helps you focus your efforts where the examiner is explicitly telling you people are struggling.
And this raises an important question, I think. Looking at the sheer number of specific rules, distinctions between tax types, and common errors we've just unpacked, how do the fundamental differences built into the tax system itself? Like how companies are taxed versus individuals, or capital gains versus regular income. How did these differences create this landscape of unique challenges? And why is getting the specific rule right for the specific tax head so incredibly critical for success? It really highlights the need for precision.
A lot to think about there, connecting those details back to the bigger picture of the tax system. Thanks for joining us for this deep dive into the TX UK Examiner's Report.
Always a pleasure. Good luck to everyone preparing.